The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. All right. Hello, everybody, and welcome back to the Value Seville podcast and part 2 of our interview with Paul Johnson. In part 2, we start talking artificial intelligence, specifically the effect that it might have on fundamental investing. We also address Guy Spears' recent Bloomberg article, "The Golden Age of Value Investing is Over." We debate it, we talk about the points, and I think we come to some pretty interesting conclusions. So sit back, relax, and enjoy part 2 of our interview with Paul Johnson.
But but I guess the question is just on the evolution of the value investor. Like that's the simplest way to answer it is that it was, the nets. And then it evolved, the aha moment of, Charlie Munger telling Buffett to buy great business at a fair price. And now it seems like it's taking this other evolution of, where and it was for a very long time, never pay for growth, but now it's pay for growth, but don't overpay for growth. And maybe that's an unfair assessment, but it's like, is it an ex post thinking, we've had such a great run over the last decade with some of the most wonderful companies that many value investors would have probably sat out on, right? And now it's like, well, let's make sure we can buy those companies because all the returns have been accruing to them. And so it's kind of more of a broader question on just the evolution of the philosophy, maybe. And just given how long you've been in this world, it'd be interesting to hear your points on that.
Yeah, I think you framed it perfectly, which is it has evolved from 100 years ago, nets to today. We're struggling with how much to pay for growth. And that's certainly an evolution. I would argue the business has gotten harder. The investors have gotten smarter. We didn't have these kind of businesses. Nobody grew at this. Very few companies grew at these paces before. So it's a new problem. We have a global economy now. We have a very big potential install base. I read a stat the other day that Meta, they don't report the monthly actives anymore, but the last time they reported in January, it was 3 billion monthly actives on Facebook. So the size of these markets is much bigger than ever before. So that's a factor, and we have to deal with it. The competition has certainly been a factor, but I'm going to challenge the question slightly, and that is, what's the goal of the exercise? Is the goal to outperform the index, or is the goal to deliver a really nice return over time to investors? And I think we've gotten away from this a bit. We're now, because we talk about the market every day, and because the S&P goes up on a regular basis, and because that becomes a headline news, and because I can buy an index fund that's very low cost and easy to get to, Graham never had to deal with this. There wasn't an index fund. There weren't really even mutual funds that he had to compete against. It was always an absolute return he cared about, and therefore he wanted to be consistent. He wanted the power of positive compounding, so you minimize the negative components in that compounding factor, and that's how he thought about it. And we now changed it so it's sort of I think we've created the gamification of investing. I think pod shops or the full gamification. They don't care, they don't care about investing. They don't care about value. They care about his information flow and getting an edge on the next investor. That's the whole game. That seems to be very good. They lever it up. They go factor neutral. I mean, they apply all this quant stuff. That's not I'm not criticizing them, but that's not investing. There was a student at school. I don't want to give too much information, but I said he was going to work for one of the pod shops out of undergrad. Very impressive. I said, why didn't you ever take our value investing class? He said, I don't need those skill sets. He said, I'm not going to be an investor. I'm going to, I think, play the gamification. Now, I'll take that one last, which is, if you, I'm hoping most people are listening to this really care about investing. Otherwise,
yeah.
I don't know why they do it. What you care about is delivering a long-term accumulation of wealth. And if you can convince your capital, that's the tricky part, that what you care about is that long-term growth rate, less volatility, very few big down things, but we might underperform, then I think you can play the traditional game of, let's go buy great companies that our expectations are too low. Now, at the end of the day, if I have a long duration investment, I'm betting either that the growth lasts longer than the market thinks, which is compounders, or the Google example you're talking about with Brett, or the growth is going to be higher than investors think. It's one or the other. there's a subtlety there. The return on capital is going to stay the same or get better. Convince your capital to do that, or it's your capital to play that game, and you can have a fantastic time investing. It's just the most wonderful thing. The moment you put in that relative performance, that's when all the craziness enters the market, enters your mind, enters the clients. You underperformed in March. Why did you underperform in March? And you said, we own stuff for 5 years. Who cares? Well, I was talking to my friend Debbie, and they own Meta, or they own it. And that's where the trouble comes in. It's the relative performance game, I would argue.
So I just mindful of the time, Donnie, I know we wanted to talk about Guy Spears' article. Should we transition to that now?
I think it's a pretty good transition point. Actually, just let me just have before we transition, one question. Let's talk about the Guy Spears thing. I'll come back to it. Go ahead.
Okay. Well, okay. So for those of you who have not read Guy Spears' article, he published it in Bloomberg 2 weeks ago, maybe, and we'll go through it in a minute. But what was it? I wrote all the notes. I forgot to write the title.
The golden age of value investing is over.
So the title of the article is "The Golden Age of Value Investing is Over." So here's what we're gonna do. I made some notes on his points. I'm gonna roll through them, and I'm just gonna ask you guys, do you agree or not? And we're just gonna go down, and I'm gonna find out where in that article we start to get some friction. All right. Fair enough.
But I think it would be helpful just to lay out the argument really quickly on what he's saying.
Okay, so he's basically saying that the information. Sorry, say again.
Paul wants to just.
All I was going to say is I think we'll cover a lot of it in Jeff's points, but why don't you give me 1 or 2 sentences on the thesis, Jeff, and then
But Paul, do you want to do that?
No, go ahead.
We basically so the informational edge is dead. All right. And because the informational edge is dead. All right. This old school idea that you can hustle to find, consume, organize, extract useful information about companies has been completely leveled by ChatGPT and things like AlphaSense, things like that. And therefore and I'm quoting him here, the golden age of value investing is dead, right? Not as many junior analysts are needed. I think literally he says the golden age of the swashbuckling hedge fund manager is dead. Asset pricing will become more efficient. We can argue that point. And I'm quoting him here, and I really like this sentence. He said, the hidden subtleties about a business that make it better or worse than it appears will be more easily revealed, right? The return on process will go down, right? Active returns are going to become less dispersed, right? They're going to kind of, become closer to the index, and it's going to be really, really hard to outperform with this technology. And then I think he says that there's really no obvious edge left out. Let's go back and let me just ask the first point. Is the informational edge dead? That's kind of his first point. It's where he starts. What say you?
No. But okay. I want to pull it apart for a second. I'm gonna stick with that. Let's do bullet points and do it fast.
Yeah.
Let's pull information edge apart. And I think there's kind of what we'll call document-based, company-issued information, and then there's everything else. And it is true that AI can review documents faster than you and I can, but we've had that for a little while. That's not brand new. But in theory, now the AI's got some limits. In theory, I could put up 10Ks and say, tell me everything they said about X, guidance, blah, blah, blah. It doesn't do the general purpose models don't do a great job at that, but the fine-tuned models and the phrase I heard, the finance architected models do a pretty good job. So that processing speeds come up a long time. And in the Oracle, guy said, he used to read through these very carefully looking for nuances. By the way, AI doesn't pick up nuance. It just picks up patterns. So that's part one. Everything outside the documents, AI has no access to that information. So I don't know how that supposedly is going to get into a chatbot discussion. Personally.
Well, some of it, like with AlphaSense, they have all the expert network calls is kind of their wall of guards.
That comes out. And that, right, exactly. So we have that. I think, the information processing of the available text-based information has definitely increased, and you're best to use that tool if you can afford it.
Let me jump down and ask you this, Paul, and Donnie too. The claim that asset pricing will become more efficient. I think we could argue that point. There's a world in which it becomes more efficient, but is there a world where it becomes more inefficient because of technology?
I don't want to get into the game of market efficiency or not, what that means.
That's another 2 hours, right?
It's an unimportant thing. And the way I really think about it is Dick Thaler wrote in the Finance FT 8 years ago, a very short article that changed my thinking. He said, the way academics talk about market efficiency is the price is right. The price is always right. And what Schiller said is because the volatility of stocks is greater than the volatility of value, that just kills the idea that price is always right. Therefore, the market's inefficient. Right. And I'm like, fine. Yeah, I don't have a problem with any of that. What Thaler says, though, however, the key thing you have to think about is not as the price is right, because we know that's not true, is can you exploit it?
Right.
And that's the trick. So he says one is price is right. The second one is no free lunch. There's no systematic, easy to define errors that you can take advantage of. And that I think is true. Now, all the academics are working on things like momentum. Does that still exist? And other kind of anomalies that they're always trying to find, can we find a systematic, what they're looking for is a systematic error, but they always judge that again against CAPM, and nobody in the real world models their performance, their portfolio on CAPM.
Well, let me double click on something you just said, because I thought it was in your book, Pitch the Perfect Investment. My favorite chapter was when you talk about crowd wisdom. And you talk about, systematic correlated errors. This idea that crowd wisdom works because everybody's guess is the right answer plus some error term. And if those errors aren't correlated over enough people, they kind of cancel out.
Mm-hmm.
But if they become correlated, then that's when you get the wisdom of the crowd becomes the madness of the crowd. Because we're all consuming information kind of the same way, create more systematic correlated errors and create, ironically, more inefficiency? Is that plausible argument, do you think?
Yeah, very, very, because what we say is we go on the key. I love the way you said that, by the way. That was really fantastic. Accuracy plus error.
Yeah.
If the errors are correlated, that's a problem. Well, guess what? As AI becomes, everybody's using AlphaSense. Everybody's using my favorite, which is Hudson Labs. Everybody's using these tools. Guess what? The models are collapsing, independence collapsing, diversity is collapsing. The chance for errors goes up potentially. And I agree with that. And I think that's the case.
So, to me, the way to exploit that, and another thing that Guy argues, which I do agree with, is that relationships become more important, right? If I can get information that is outside of that system because of legal, of course, information outside of that system and get nuance and insight that I can exploit those errors, to me, that's, in my mind, this is my opinion, but that's kind of the future of this. Like, I think the idea of the person who's not very social, that sits in the basement and just consumes information, being a good investor, I think being able to be social, go out, get networks, build networks, and get insights that just are impossible for an AI model to spit out. To me, that's an edge. I don't know if you call it a social edge or whatever, but it's an edge to me.
Yeah, we need to add, I love what you just said. I want to add a framework, take 5 seconds, which is that investing is information plus judgment. Get the screen here. And all the guy talks about is the informational piece, which ironically, because he's a very very thoughtful guy.
Very thoughtful person.
I'm very smart, that he gives in the article, he gives absolutely no credit to the judgment part. And Jeff, what you just said is that judgment part with the relationships, you're getting information that's non-AI driven. Plus, you're getting the subtleties and the nuance, and your target, this guy's always good at this gal's always good at this, and I can kind of use that. And then my ability to add, we always call it analytical advantages, figuring stuff out before the market did. And I think that is always going to be, it's Mario, it's Ackman, it's Buffett. They process information differently than I do. And their track record would suggest better than I do. So not just different, but better. So I don't think that goes away. Now, one thing you said on this setup, which I like, and Mobison's done a lot on this, is the dispersion of alpha is shrinking, but that's been going on for 30 years.
Yeah, right.
That's not new. So I don't think AI is, I think when I got into the business, I walked in as a young analyst, very young analyst, and there was a senior analyst. I said, why are you doing your models on green accounting paper? He said, how else am I going to do my model? There's this thing called a spreadsheet. This is Lotus 1, 2, 3 to just come out. And he's like, what's that? I showed it to him and he was blown away. So I did all my models on Lotus, then Symphony, then Excel. Then we got to the point where we downloaded data from a data source. We don't build models. Originally you got faxes, financial release now. So everything has sped up. To me, this is exactly the same thing. Really good at absorbing documents and information. By the way, I think this is more powerful for the generalist than it is the specific, because the generalist can go to something new and say, teach me everything about specialty chemicals I need to know in 3 days rather than 3 months.
This is a good point. because as we all know, as everybody here is a big fan of Bruce Greenwald, and one of his big things is specialization. But I hadn't thought about that until you just said it. But you're right. You don't need to be necessarily as specialized now if I can use a tool to become maybe not an expert, but pretty damn good over 3 or 4 days of research. I'm still processing. That's a very good point, Paul. I like that a lot.
Yeah, Paul. I mean, one thing that I think about is maybe it's related to this, maybe it's not, but I think it's probably in that ballpark. The concept that one of the frameworks that I think about quite a bit is Bill Miller's cone of uncertainty and the dispersion of outcomes, especially as you go out longer. And I just, in my mind, can see, and this is probably from being beat up in the trenches daily, but is the code of uncertainty. The companies that are the hyperscalers today, I can see the pathway for a lot of them to succeed. That they have a capital advantage that I think is really important. But for these other, 3,000 publicly traded or 3,500 publicly traded companies, the code of uncertainty, I think, is widening for so many of these people, for some of these different types of companies, and we don't really know what's going to thrive, in this next world in the next 20 years. And So I just think that has to, by definition, lead to more inefficiencies in pricing today. I don't know, maybe I'm wrong on that, but I do think the dispersion of outcomes today just seems so wide because we don't even know what this technology is going to do, candidly. I mean, we don't know.
We don't know.
Yeah. So, I mean, I don't know.
And just to piggyback on that, more and more capital is focused on the obvious winners, whether vaccine or, shadow index, that the rest of the world is becoming less covered. And certainly if you use the model we talked about in Pitch the Perfect, as the number of N's goes down, the chance for that to be mispriced goes up. And so I always said, you don't have to figure out Google, particularly if you're not playing the chase the performance game, and you can go figure out stuff that no one's looking at. My favorite call was always call up a CFO and he'd say, "Oh my God, I haven't talked to anybody in Wall Street in a year." Doesn't mean it's mispriced, but boy, that consensus is not as robust as Google.
Yeah.
And if it was a really good business and I had a pretty good management team and they know how to allocate capital reasonably well, you're paying less for those returns than you would in other situations. I think that is, I agree with you, Donnie. I think that opportunity is increasing because everyone's looking over here. And that means we got a bunch of less covered things over here.
Yeah. There was a company like we had that experience. We were with the CEO of a company and he was like, "I'll talk to anyone for hours." Small investors, and he's just like, "I don't care. No one wants to talk to me." I mean, and the company has literally, I think since then, it's X'd multiple times. It just was uncovered. No one followed it. I think there was like 2 equity analysts. No one cared, and still today, no one cares. And the company's buying back an enormous amount of shares. But yeah, to your point, there just seems to be pockets that are so forgotten, and these guys really want the attention. So I think there's a lot of inefficiency.
They'll listen, not in an activist sense, but you say, "Hey, listen, you know what? I think you might think about that. Oh, well, we hadn't even thought about it. Can I present to the board?" And, I think that the best investors these days is a bit smaller cap. You can decide what your target is. And an activist in the sense of you're engaged with management and helping them understand all the street things. And if they own some stock and say, "Look, I'll show you a path where you can retire rich without cheating or forcing or private equity or anything. And this is how it's compounding. And let me show you how we can do that." And they're willing to listen and stuff. I don't know. That to me was always the most fun. Then you get up early and I don't know. And if you can get a portfolio of 10 of those or 15, whatever your concentration is, that now you got to be able to convince your capital, "Hey, listen, if you really want to play the game, go put some money with the indexes or go put the money with whatever. And then give me the money you want to give to your kids, because I'll grow this tax deferred with a really nice compounding return over time, but I'm not looking at the indexes every day."
Yeah.
That to me is like convincing capital that's the way to go.
And convincing management to listen to you and be willing to listen. I found that's to be a challenge too.
I had a management team, we sent them articles, they read them all and they said, "Oh my God, this really supports our strategy." I'm like, wait, the stuff I sent you does not support your strategy. How did you take that for this? Yeah. Confirmation bias in its truest sense. Okay.
So Donnie, I know we're conscious of time here. What do you think?
So Paul, this is a personal question. Okay. And this is very much putting everything aside to some degree. And it's probably, will seem a little, maybe even asinine, but if we were just to take, I have an 8-year-old son, right? We take a very first principles approach to growing, to getting wealthy, right? In a sense, is the question that in some sense, we're all asking. Do you think like and I think you're trying to correct this with this value growth thing, so I'll caveat that. But you think that some of the value philosophy, could it be a limiting belief? And is it more deterministic to just go with the next hot thing and just throw all your money at that? I mean, and you can, doesn't have to be that you're that smart, but if you would have gone back over the 20 years and said, all right, mobile phones are big, I'm putting all my money there. I'm going to go put all my money AI or Bitcoin. Even if you didn't know anything about it, you just said it's going to be some hot thing. You would have gotten screwed with NFTs. But over and over again, these guys that, we go to a lot of conferences, or these guys who have no idea what they're doing, but they just throw money at these hot things. They made enormous amounts of money. And I just wonder, is there just a more deterministic pathway that involves just maybe playing the odds, differently than the value kind of philosophy?
Well, this is one of those questions I could spend an hour on. But, let me see if I can limit it to one. I was talking to a very famous investor in New York. And he said, this is a couple of years ago, and he said, you know something about crypto? Because I taught crypto for 5 years. And I said, you said it perfectly. I know a little bit about crypto. That is true. And he said to me, this is a very seasoned investor. He said, I wish I bought Bitcoin. And I said, no, you don't. And he looked at me like, wait. And then he said something, which this is where my anal personality kicks in, because I don't understand the question. Because people say, how can you say that? And I just literally don't know what that question means. I mean, they're not asking the mechanics of voice. I think what they're asking is, why do you believe that? As opposed to, how could you say that? And I said, trust me, you don't. You wish you had. And he said, wait, you're smart. Explain it to me. I said, all right, I'll humor you. What price did you pay for your Bitcoin? He said, 1,000. I said, all right. So you bought an asset, you know nothing about it. It goes to 3,000. You tripled your money. What are you going to do? He goes, oh, hold on. I said, no, NFW. There's no way you're going to hold on. You're going to sell it. It's going to go to 18,000 and you're going to blow your brains out. He said, no, I held on to 18. I was like, okay, great. It then goes back to 6. You're going to blow your brains out. All right, then it runs to 35. Nobody likes vol, and things like that have more vol than you can imagine. You would just lose your mind. If it was in a fund, you're going to drive your investors crazy. Those sorts of things, say they're speculative assets, like gold. I spent 3 or 4 years trying to understand gold a while ago, and it finally dawned on me. It's just a speculative asset. People believe it has no functional value. And so every price, I put out a piece in January on Bitcoin. Every price for a speculative asset can be defended. So stop defending them, because they're all the same. And they're a function of supply and demand. If you want to play that game, or you're going to deal with vol. So I'd be careful of those sorts of things. Now, if you stop and you say AI is big and we're going to invest it, that's at least more of a fundamental argument. So that's the case. But I guess my pushback on the question, what is the goal of the exercise? Now, you said to get rich. Now, if you want to get rich, God bless, and you guys are good friends, these relationships are important. I'll do everything I can to help you get rich. Although I will ask along the way, why do you want to be rich? And it's a trickier question. But there's a second question, which I'm really passionate about, and I spend a lot of time in my class on. Do you want your kids to be rich before they learn how to make money? And the answer is no. The evidence there is overwhelming. And I don't know you guys' background, but I will bet you each a lot of money you did not grow up rich. And I will bet that you did not grow up with a lot of money. And the reason I know that is because you're driven and you're curious and you go to work every day. And you really ask yourself is, do I want to disable my kids' education by giving them too much money? And I think that is a subtlety that you need to think about. And no one has come up with the right recipe once they get rich, how to deal with their kids. It becomes harder to parent, not easier to parent, because you now have this overlay. So if you want to get rich, I will say great, although I'm not sure why. If you want to be rich because somehow this is good for your kids, I will try to disabuse you of that craziness. You want your kids to learn like you did, driven, curious, want to learn. Now let's think about the other part of your question. I think investing is investing. And I think what you want to do is be able to sleep at night. And the way you don't sleep at night is owning stuff you don't know. It's got a lot of it's stuff with a lot of uncertainty. And that ruins life, because you just, this is not too personal to share with you guys, but too personal for the thing. But I was rich at 40 years old. I mean, real rich. And then they had the tech bubble and a bad divorce and some other things, bad real estate. I mean, a lot of stuff. I am significantly less rich today, and I am significantly happier. And
awesome. I mean, Paul, I appreciate you shared that. There's wisdom right there.
Yeah. So I think, by the way, I work harder now than I ever in my life. Maybe not ever, but because I am so passionate about these ideas and teaching and writing, and and engaging with people like you. I mean, just for me, my wife was like, "What are you doing?" And I said, "I'm engaging with two really smart guys for a couple hours. It happens to be a podcast, but I'm going to learn a ton about the way to present and think. They're going to ask great questions, which has all been true. And that's what drives me. It's just that understanding and pursuing it, and investing to me is the ultimate activity because it's forcing you to really engage in a social network, the market, and challenge whether or not you can play the game well. And performance in my mind is, it doesn't have to be relative, but performance is you've mastered some skills. It's no different than playing a sport or playing a music instrument or anything, chess or anything. If it's really something you're passionate about, you want to play it as much as you can. And then
Right.
the test is how'd you do? And what did I learn and grow? Now we need
Right.
capital, so we need investors and all of that. So to me, the game is, I don't think Stevie Cohen really cares to be worth another billion, but I think he loves the game. And
Yeah.
he's in the game every day because he wants to see how he does against the other smart people.
He
And I
loves
know
he loves baseball too now.
yeah, exactly. And
Yeah.
if he could figure out how to translate money to performance, there'd be a lot of Mets fans.
Right. Paul, I'll just
That's a great answer, Paul, and I appreciate that. There's so many nuggets of wisdom in there, but the compounding from learning I would have never gotten on this path, I think, had I not really dove into the value-oriented philosophy. And I credit just being an acolyte of Munger. I mean, I picked that book up. It's all over my house. I mean, and that's what's really helped me. And then I think seeing like meeting people like you in business school and other people who are in this field, and me and Jeff have endless conversations sometimes just about a random stock that neither of us are invested in. But
yeah.
there's just, I wouldn't have that, I think, desire to learn had I not gone on this path. And that compounding, to your point, is worth a lot. And so, it's a very, so I appreciate that. It's a great answer.
Paul,
A lot to think about.
I'll answer your question on why do you want to be rich or what, and I'll even give it a little bit of a, like, what's enough money? To me, being rich or having enough money is to choose how you spend your day. If you have enough money to be able to choose what I do, the stocks, you don't need any more. As long as you have freedom to choose your own adventure, so to speak. To me, that's, and whatever that number is, I mean, once you go beyond that, I feel like it's superfluous and probably would make you do unwise things too, potentially.
I love that, Dan. I think you've nailed it. That's the A+ answer. Is it gives you freedom to do. Time is the only resource that's non-renewable. And if you set yourself up financially, now there's two parts to that, right? Spending and earning. If you can set yourself up that you could absolutely have complete freedom over your time, you won the game.
Well, I'm going to tell you, I'll pitch an idea to you. The pumpkin coffee I mentioned it's worth the extra couple bucks. It's really good. Just saying. It's a good, wise way to spend your money.
I like that. And there's one other personal disclosure is I don't drink caffeine.
Really?
Oh, wow.
Yeah. That's good. Good to know.
My wife is from Colombia and she has coffee in her veins.
Okay.
And she drinks it every day. And it's her favorite moment of the day.
Yeah.
And we found the coffee she loves. And I figured out how to make it better than she can. So it's my little
awesome.
gift.
But you never partake yourself. That's yeah. Well,
I love flavor coffee. A tiramisu, spectacular. Coffee ice cream, spectacular. But it's the caffeine. I just don't.
Caffeine.
And it's not a religious thing. It's just my body. I have enough energy. I don't need it anymore.
Well, I mean, look, you definitely have a lot of energy, Paul. This has been great.
Yeah.
So we should wrap this up, I think, just because we're hour and 20 something in. Any last parting thoughts or anything on your end, Donnie?
No, other than love to continue learning from you, all these years later. This is definitely a treat, and hopefully this is the first of many. I mean, we're not going anywhere, and you don't sound like you're going anywhere. So we'll love to hear back and see how this evolution of thinking is in a year from now, 2 years from now. So, definitely a great conversation.
And Paul, really appreciated you guys being involved with Value Seville, and I think this just building a network of like-minded people that are just trying to figure this stuff out. It's so powerful, and to kind of dovetail back to this idea of social networks being an edge in the future. I think that's something and you mentioned in another, I think when you were at Guy Spears' event, that you learn actively when you teach. I went into this call being a little bit more pessimistic, if I'm dead honest with myself, on active management. And I'm coming away from it feeling more optimistic about the role of active management in the future. And so I want to thank you both for that.
Wow.
Yeah.
Yeah, I mean, and
Yeah.
it's Friday, and it's putting me, Friday, you're always in a good move. But if it renews your belief in active management, that's even a better Friday. So
That means I'm getting phone calls next week on some ideas. So that'll be fun.
All right, excellent. Listen, I love this. You guys are great. Anything I can do to help, let me know.
Yeah.
All right. Well,
Okay.
everybody, thanks for joining the Value Seville podcast. Please, if you like what you're hearing, spread the word. Give it a like, all that stuff. We'll put Paul's material down in the notes. So if you're not familiar with it, you can watch his lectures. He's very generous by posting his lectures on YouTube, and it's really fantastic material. So I would recommend you all check it out. So until next time, take care, y'all. Thanks a lot.
Bye-bye.